Good morning. You are watching a live market outlook for Wednesday, 15th of February 2012. Near-term recovery of most of instruments, despite again failure in Greek conversation with the Eurozone still persists as the Euro and Sterling are in a near-term up move after hitting fresh lows yesterday, as well as gold and crude oil recovering further, especially on the fears of crude oil, especially on fears of possible failure of supply from Middle East as tensions in Syria and the recent bombing of the Homs area where the main pipeline was hit, increased fears of investors of possible shortage of oil from Middle East. Gold is again ticking higher, still holding hopes of finding a solution for a Greek problem, closing the deal actually before the time ends and enters Greek in the disorderly bankruptcy. The most significant was rally of dollar against the Japanese yen that broke some critical levels and shooting higher towards post-intervention October 2011 post-intervention highs at 79 and 79.50 with a very strong uptrend in the short-term outlook, suggesting a further recovery of the pair after it hit levels at 76, close to its record lows. As said, Greek leaders and the Eurozone finance ministers have dropped the plans for a face-to-face meeting that was due today on Greece's new international bailout, saying that party leaders in Athens again failed to provide the required commitment to reform. With the European Union's patience at breaking point, ministers downgraded the talks just to a telephone conference call, almost certainly killing off any chance that would approve 130 billion euros bailout on Wednesday, which Greece needs by next month to avoid a messy bankruptcy. Ministers in the Eurogroup said Greece has failed to say how it would fill 325 million euro gap in budget cuts promised for 2012, and also to persuade all party leaders to sign a commitment to implement austerity measures after an election expected in April. The Greek government source said yesterday that Antonis Samaras, who will probably be the next prime minister, would sign the commitment today, again running up against the deadline and infuriating EU leaders. Samaras has criticized the measures which Parliament passes early on Monday, and protesters wrecked buildings across the central Athens. He says the cuts could plunge the country already in its fifth year of recession into even a bigger slump. When Parliament debated the austerity package on Sunday, he indicated that he would try to renegotiate the terms of the bailout, increasing doubt in the minds of European leaders. This, as we see, that and the story and no solutions so far. We'll keep watching this closely. Also today there is a full calendar for the day with some indicators already released, as German preliminary preliminary GDP has already been released, showing the German economy contracting by 0.2%. I apologize, there was a technical problem. As said, the German preliminary quarterly GDP showed a shrinking of the economy by 0.2%, again better than the forecasted minus 0.3%, but compared to the positive plus 0.6 growth in the third quarter. From Europe today, still to come, the UK's climate count change at 9:30 GMT, 3.2 thousand is the forecast of new applications for a jobless compared to 1.2 thousand in the previous month, with unemployment rate unexpected to stay unchanged at 8.4%. Average earning index from UK is expected at 1.8% compared to 1.9% previous month. Swiss zoo economic expectations, no forecast for today. Minus 50.1 was the previous release. And at 10 o'clock GMT, Eurozone flash fourth quarter GDP, again, contraction is forecasted minus 0.3% compared to plus 0.1% in the third quarter. At the same time, Eurozone trade balance is expected to narrow by 3.5 billion euros compared to 6.5 billion euros surplus in the previous release. UK's inflation report is, Bank of England, pardon, inflation report is due at 10:30 GMT when Governor King will have a speech. From the Americas, Empire State Manufacturing Index due at 13:30 GMT, 14.7 is today's forecast, slightly better than the previous month release at 13.5. Later at 14:15 GMT, capacity utilization rate expected to improve to 78.6% compared to 78.1% previous release. At the same time, U.S. industrial production is expected to grow by 0.7% compared to 0.4% of the previous month release. Crude oil inventories are due at 15:30 GMT, and another raise in the crude stocks by 1.8 million barrels is expected today, compared to last week's build of 300,000 barrels. The FOMC meeting minutes are due at 1900 GMT, and that would be all from today's calendar. Now we are going to take a look in the markets and see the latest movements. Euro, as we can see in the steady downtrend, near-term downtrend of 133.19, high of 9th of February, where gains were capped by 90 days moving average as shown on the daily chart, with the further easing seen after break below 131.53 last Friday's high. That is also trend line, main trend line of 13 January low at 126.22. Further extension lower dipped so far to 130.79 after losing 131 and 130.90, the next static support zone. At 130.79 yesterday's low, the temporary support was found, and the pair is now heading higher. On the upside, immediate barrier is 20 days moving average at 131.89. That has so far been touched only, ahead of a brief reversal lower. We need to see the break above above the Fibonacci level of 50% at 132. Fibonacci of retracement of the latest down leg from 133.19 down to 130.79, which is also the low of last Monday, of opening of last Monday, when the euro opened with the gap higher. So this is our initial barrier, and the more significant is 132.14, the high of yesterday, with break here required to confirm the bottom at 130.79 and allow for a stronger recovery. Failure to regain 132.14, my signal again, a fresh lower top and a further extension lower, as the hourly studies already started pointing lower, and if 20 days moving average caps the upside, then most likely scenario would be lower top at this point, 131.89. as the 20 days simple moving averages in past 2 days maintaining the recent downtrend, and the signal of further weakness came on the break of this one. So holding below 20 days simple moving average keeps the focus at the downside. Break below yesterday's low at 130.79 to attract the next very strong support and higher platform at 130.25. Also the recent range floor, loss of which to open way for a stronger recovery, for stronger correction. The daily studies are also in a way losing traction after 90 days. Moving average capped the upside with immediate support downside at 130.60.55 days moving average, as the pair is currently struggling to hold above 20 days daily moving average with the brief breaks yesterday and today below, signaling possible further weakness and test of 130.79 and 130.25. That would signal tops and the short-term rally being on hold in favor of deeper reversal. The sterling is again in the steady downtrend from 159.26 high, where also 200 days moving average limited the short-term rally from 152.33 low of 13th of January. Steady decline from there is defined by the trend line connecting a series of lower tops with the pair losing the critical near-term support of 157. At 157.30, they are the lows of 6th of February and 10th of February. That also marks the head and shoulders pattern neckline, with break here to signal a further extension lower. 20 days moving average shown on 4-hour chart currently at 157.45 maintains the near-term downtrend along with the bear trend line drawn of 159.26 with the failure to regain the trend line at 157.56 and the previous high at 157.69, again to signal a lower top and possible extension of the downtrend from 159.26 with immediate targets at supports at 156.73 overnight's low and 156.43 yesterday's low, break of which to open the way for test of 156, which is much level. Pardon, at 156.40 low of 27th of January and possible extension down towards 155.80, which is 50% Fibonacci retracement. First Fibonacci level is 38.2% at 156.60. That has already been dented yesterday when the pair dipped to 156.43. Regain of previous high at 157.69 and break above the trend would provide the near-term relief and allow for a stronger recovery. The dollar yen remains in a steady uptrend after finding support at 76 zone and the clearance of very significant and strong barriers at 78 zone, where was the main long-term bear trend line and 200 days moving average, as well as 78.27 previous range ceiling. Now is rallying higher with 78.65 seen so far. The pair is en route to 79.00 and 79.52 October 2011 post-intervention rally and rally peaks with the positive studies expected to extend the gains, especially that latest action of Bank of Japan that we were talking about yesterday now turns investors into dollar, and that this is pushing the already strong Japanese yen that is now harming the Japanese economy. Our daily studies are turning into positive territory, but approaching the overbought zone that might signal, as well as 4 hours already deeply in overbought territory, that might signal a sort of consolidation correction before the bulls resume, as the trend remains fairly bullish. The initial support is overnight's low at 78.34, along with the previous highs at 78.27, with the dynamic one at 77.89, 20 days moving average, and the previous high at 77.80, expected to contain dips in order to maintain the immediate bullish tone and keep the focus on the upside, or break above 79 to focus the spike at 79.52 that was printed after the intervention of Bank of Japan at end of October 2011. The dollar Swiss is back to the range after unable to sustain gains of 91.00, where the temporary good support actually was found, despite the brief break lower to 90.87. It proved to be false break, as the pair quickly regained strength, and yesterday's rally through previous day, last Friday's high at 92 zone, again failed, running out of steam on approach to 92.50, our next strong barrier, at 92.27, and quick reversal lower below 92.00 keeps the pair in the sideways movements of broader range from end of January. On the upside, the 92.50-60 range ceiling offers a good barrier for now, despite sort of positive studies on the short term. Still, the pair still unable to reclaim these levels. On the downside, 91 is our initial support break of which, and 90.75 Fibonacci retracement, 50% of the October to January upleg, to signal an extension of the downtrend from 95.93 beginning of January high. The 90 days moving average on the daily chart so far keeps the upside limited, with the 20 days coming now, attempting to cross below 90. That will give us another bullish signal for further extension of the near-term downtrend from 95.93. A break below 90.75, pardon, where is also the Fibonacci Ichimoku cloud base, opens next 90.00 and 89.55 Fibonacci 61.8% retracement. A brief look at the commodities. Gold ticked higher again after initial failure at 1733 zone on 2 days ago, as support was found at 1710 zone, just ahead of our strong support at 1704, 1700, with fresh gains now underway. However, the wider picture still shows the gold price in the downtrend of 1763 high of 3rd of February, and as long as the trend line drawn of there, currently at 1735, holds the upside, the focus remains at the downside, with possible further ranging, as this was established as from 10th of February, the past couple of days ranging might precede further weakness. Only break above the trend line would provide near-term relief. However, a break above our next significant levels at 1750 and 1763 is required to improve the short-term structure. On the daily, break of the main bear trend line of 1920 high of historic high of gold keeps the positive structure on the wider picture, with studies still in the positive territory, and the 20 days moving average currently containing dips, keeping a focus on the upside. 1750 and 1763 are in focus. Only loss of 1700 support would allow for a further weakness, and a possible test of series of moving averages 1685, 1669, and the main one 200 days moving average at 1660, loss of which would also signal a return below the broken trend line and extension of the broader down move from 1920. Crude oil, as said, is in a steady uptrend from last week's low at 95.43. Break above 100 level, and the bear trend line of 103.72 recent high has so far seen 101.82 also clearing the previous double top at 101.20 zone, heading towards 102.20 our next targets. The studies are positive, but in a way stretched, and I would say some corrective action might precede the fresh rally. 20 days simple moving average at 100.17 along with the previous highs is expected to contain dips in order to keep the near-term uptrend intact for a fresh attack towards 102.20. Good luck.